If you want to retire early and you have an eye towards tax planning, you're going to have to come to this realization sooner rather than later. It's simply this: there are trade-offs. There is no such thing as the perfect magic bullet strategy that will allow you to pull all the levers and do everything you want to do all at once. It just doesn't exist. So my job as a financial planner is to help you understand what are the trade-offs for the things that matter to you. This video is going to discuss two of those trade-offs, and they are: how do we still think about ACA premium subsidies in early retirement with Roth conversions? How do we hold those things in tension at the same time? Because they work directly against each other. This is something that I hear a lot, and there's really no one answer to it, but what I'm going to do is give you some insights into how you might want to be thinking about your early retirement when it comes to these two trade-offs. I'm also going to highlight what I think is the most powerful retirement account, which is the brokerage account. It's so flexible. It is not something the government ever tells you to take out, and they have no hand in it. It's not something that's locked up until 59 and a half, on and on. There's so many benefits to this type of account. So I'm going to talk about how that plays into your distribution strategy if you're someone who's thinking about, how do I think about ACA premiums and Roth conversions? Which ones should I prioritize and why? That's what this video is all about. My name is Forrest Dutton. I am the owner of Brightworks Financial Planning. I'm a certified financial planner. I love doing these videos. The goal is to help you retire with confidence. These videos, I hope, are as educational as possible for you, but they are not personal advice. It is not meant to be financial, tax, investment, or any other type of personalized advice, but it's meant to help you be more confident in making these decisions. So without further ado, on the rest. Okay, let's discuss. So today's topic, again, is going to be balancing premium subsidies through the ACA if you retire early prior to 65, and also doing Roth conversions. So which one to choose? And again, this is a trade-off, and I want to present it as such. So what I have is Jim and Claudia, and let's just use age 60 for this case. They want to take a 5-year period until they get to 65. They want to do Roth conversions because they know they're going to need Social Security later on. So they're trying to utilize this where they don't have additional sources of income. So it's a great window for them. But they're also trying to look at healthcare and their ACA premiums. So again, this is not personal tax advice, but this is a tax planning software that I utilize when I look at scenarios like this. I'm just going to give you at a very high level why I would advise, again, this isn't personal advice, but in this fictional case, what the pros and cons would be in terms of doing a certain amount of Roth conversions and along with a distribution strategy from their retirement or non-retirement accounts. So I'm going to set this up for you. This is all happening in year 2026, and for the sake of this case, we're going to determine that they want to live on $60,000. That's really all they need. Let's just assume there's a mortgage that's paid. They're retiring and they don't need more than $60,000 as a married couple. So in that case, if you've ever looked at an ACA premium calculator, if they were to just live on $60,000, whether that comes from a brokerage account or that comes from even IRA distributions, for a couple married filing jointly, that's going to put them below the premium subsidy cliff. And basically that means if you're above 400% of your poverty line for your family size, then you will get a substantial benefit in your healthcare premiums. Now, that's not where this case ends. So that's what they want to live on, but they also want to do Roth conversions. So the irony there is if they do Roth conversions, then they will have basically no benefit whatsoever on those premiums, which could cost, depending on where you live, multiple thousands a month for their health care. So it could, let's just use $2,000 for the couple. That could cost them $24,000 in the year. That's a lot. So what I'm going to show you here is what if they do the conversions. We'll talk about the healthcare piece aside in a minute, and I'll tell you why I think for most people, if you've already made that decision to do Roth conversions, the decision to do that should be larger than just the healthcare decision alone. Meaning you should not forego Roth conversions just so that you can get an ACA premium break, and I'll get more to that in a minute. But for now, let's talk about the actual nuts and bolts of this case. So they want to do a $100,000 Roth conversion. They want to live on $60,000. And how do we get to that 60? Now this is where the brokerage account comes in. Such a powerful account. So we're going to assume that they have amassed a pretty sizable brokerage account. Now, again, how much depends on, again, what you're able to save over your working years. For most people, their employer account is going to be the first place that they go to put money. For most people, that's a 401k. In this case, I'm just going to assume they have $500,000 in a brokerage account. It could be more, but I would say 500 would be a great place to start for this. So over these 5 years, they're going to take the money that they need to live off of in column 1 from their brokerage account. Now, all that does is, what this column is showing you is what would that actually mean from a tax planning perspective. So what can we project? So if we assume that there is an account and they take $60,000 out of it, let's just assume that 40% of that is taxed as a capital gain. That's the number you see here on the left. That's how I got $22,000. So if you just take $60,000 and you times it by 40%, you get 24. Now, why does it say 22? The reason being, we want to try and stay below the 0% capital gains bracket. Another reason why the brokerage account is undefeated when it comes to retirement planning. Perhaps maybe by Roth, but I digress. Still a really, really great account. So in this case, what I would assume is that they have enough cash to meet that other shortfall. So they may actually take a little bit less out than 60. This may represent more like 58, and they live on a little bit of cash, because if you are a couple married filing jointly in 2026 and you're under a certain amount of taxable income, those capital gains will be taxed as 0. Now, here's where it gets complicated. Even though those are taxed as 0 for federal taxes, they still are going to be added to what's called your modified adjusted gross income when it comes to the ACA premiums. So even if this Roth conversion did not exist and they took out, let's say, $100,000 from their, let's just make it easy. Let's say they took out $98,000 exactly, because in 2026, $98,000, as long as your taxable income is $98,000 or less, that will be 0% on those capital gains. So you may be saying, well, they shouldn't have to pay for premium subsidies because they didn't pay any tax. Well, that's not true, because that still represents their modified adjusted gross income, which at $98,000 would put them above the 400% poverty line. So they would still have to pay more in for their premiums if they wanted to have an ACA compliant plan. So all that aside, what I've done here is I've shown you what happens if we do a $100,000 Roth conversion. And what you'll see here is the benefit of the brokerage account really shines through here, because remember, a Roth conversion is nothing more than taking the money from your tax deferred or traditional IRA, and you are taking it out and paying the taxes now. So all $100,000 of that is going to be taxable to you as income. Now, what you'll see is there are things like the standard deduction and other reasons where it won't be the full $100,000, because you will get somewhat of a break, but it's all going to flow through as taxable income. So really what we did is we just added everything together. So we added our 100 from the Roth conversion, our 22 from our long-term capital gains, and then we also added our total dividends, which is going to include qualified dividends, which are taxed like capital gains, and ordinary dividends, which are taxed like income. So what we have here is our taxable income amount, and what is the actual total tax there? Well, it's about $8,200. So an important thing here is, again, you can see here a 0 at the long-term capital gains marginal bracket, which means that even if they took out $1 more from the brokerage account, it would still be taxed at 0 because they're underneath that bracket. Now, what this also shows you is that their income is in the ordinary 12% bracket, but I really like the effective tax rate. So what that basically says is, how much tax do you pay relative to your taxable income? So it just takes this 8,200 number, divides it into 98,000. Now that looks pretty good. Now you may be saying, I think I'm pretty confident that maybe in the future, if you're going to be drawing out your pre-tax assets higher than this 12% bracket, I would even argue higher than 8.4, this will be a worthwhile conversion if that's something that you decided beforehand that would make sense. And if you did this 5 years in a row, you're going to get $500,000 into a Roth, because I also am running in the background of this case that someone has saved us a decent amount of cash. I'm a huge fan of early retirees. amassing enough of a liquid cash account. That could be high yield savings, money market, whatever you want to call it. But those taxes, where are they going to come from? I would argue they should just come from the cash account, because then they don't have to come from the brokerage and they don't have to come from the conversion itself. That is really efficient. And if you just take $8,000 times 5 years, it's really only $40,000, again, give or take, if you keep this strategy throughout that early retirement period. Now, ideally, what if you had $100,000 saved? Well, then you could decide how much of this you want to live on and how much you want to utilize for Roth conversions. That would be another way to utilize cash to draw this down in terms of how much you're actually paying on these conversions. Now, I just wanted to, for demonstration purposes, to show you, what if we took the full $60,000 and we were not diligent and we didn't have a brokerage account? Well, that makes a huge difference, because basically now you have $160,000 plus your ordinary dividend money minus the standard deduction, and now our taxable income is much higher. So we're paying over double. So what I wanted to show you is that the tax code is not linear. So meaning, hey, we lived off 60, does that mean we just pay? I mean, you pay more than twice the tax in this case. So it really benefits you. So if you have some years left and you're watching this and you have 10 or 15 years towards retirement, you really should be thinking about building up that brokerage account if you're somebody who's thinking about doing Roth conversions earlier in your retirement period. Now I'm going to show you a hybrid between these two. So the general rule of thumb is that if you're doing conversions early in your retirement period, you don't want Social Security income, because that would then add more forced income on top of the conversions that you're already doing. But for some people, what if that brokerage account's not as healthy as you thought it was going to be, or maybe your cash account is not as high as you wanted it to be? Well, in this case, what I've done is there's a lower capital gain amount because it represents a lower amount taken from the brokerage. So they don't have enough, they don't feel comfortable enough to take 60 out, they're just taking 40. So that's how we got 16,000. Remember, we're just taking 40 and we're taking that number, which is going to be 40% of that is 16,000, which is your capital gains. And then they have one spouse, probably the lower earner. So when would this even make sense? So say you have a spouse that you know is going to earn much less than the higher earning spouse, and maybe you want to preserve that Social Security till 67 or 70. This could make sense to have that lower earning spouse drawing at age 62. So in this case, we would have to push this from 62 to 65, so you wouldn't actually be able to utilize this as many years, because then again, when it comes to subsidies and Medicare, that's when this period would end. But for sake of making this the same as the other columns, this would start at 62 and go to 67. So over a 5-year period, you have less coming out of the brokerage, that's the pro, but you also have already started drawing social. So if you wanted, if this is a married couple and the lower earning spouse got this, their spousal benefit is going to be reduced later because they decided to draw early. That's a whole nother video. But just to understand, this could be an alternative here. It's a hybrid between these two, so you're not going to pay as low of tax as you did in the first one, but you're not going to pay as high there. So depending on where you think you might be, this could be a good happy medium. But I want to make the case that I think that this Roth conversion for most people is worth it, because to me, in my opinion, if you got to this point and you're looking at tax planning, you saved all your life. In my opinion, when you get to early retirement, these are your healthiest years, the years that you can utilize the most. It's not worth it to try and live under a poverty line just so that you can get a break on your healthcare cost. There are other options. So meaning there are cost-sharing options. Some of them are faith-based. There are others that are not. That's something you could look into, and those don't cost near as much as an ACA plan. Now, I'm not endorsing those, and I'm not even mentioning a specific company. But in my opinion, if you work that hard your whole life, I don't think it's worth it to scrape by to try and live under the poverty line when you actually have all the money you could now to be living on. Now, when would the middle column make sense? Well, that's somebody who has a really, really sizable IRA, and they know later I'm going to be paying a lot more than this. So I don't mind taking out 60 in addition to the 100 of Roth conversion, because I think that my bracket later is going to be 24, or I think that my effective rate is going to be well over 15. If both of those things are true, this would actually make sense. And this person would still be living the life they want to live. So they could still live on their $60,000, knowing that their sizable IRA is being drawn down earlier, which may mitigate the required minimum distribution plan in the future, which is the reason that you're doing conversions in the first place. So again, this is not tax advice. This is not a personal advice video. It's just to educate you that these things do work together, but I am not really a fan generally of trying to live so frugally for 3 to 5 years that you are, I'm not going to use the word throwing away, but you are really limiting the value of those years in terms of your health span, your lifespan, the things that you can do. So I think a much better plan is to just plan accordingly and really bring up that brokerage account so that you can do both, so you can still live the way you want to live and still do Roth conversions. And if you find yourself in the camp of, you know what, I understand this Social Security maximization game, but I'm not so convinced, then maybe this last column is more the plan for you. So the point here is to show you that there is no one size fits all. It all works together. Everybody's plan is different. And if you need help with your personal situation, that is exactly what I do at Brightworks Financial Planning. Feel free to reach out. I would love to know your comments. I'd love to know what other factors you think come into play when it comes to this decision. Did I miss something? Is there something that you want to see emphasized? Do you have an idea for a future video? Love to see it. So as always, please like, subscribe, and I will see you on the next video.